Hi ladies and gents, welcome back. Okay, this is going to be video number 44, but video number 6 of module 3. Alright, and this time we're going to be using the Bollinger Bands. Alright, and as before, here's your template section. Go ahead and I've created another template and choose this one down the bottom. Alright, now what I've done, I've skipped the average true range and I've skipped the awesome oscillator, because with the accelerator oscillator and the awesome oscillator, they don't really bode well with each other. Okay, the bear's power and the bull's power don't really work well with the accelerator oscillator, so I've disregarded those. Alright, but I've used the Bollinger Bands in there and I almost disregarded this one with that particular combination. Alright, just those two combinations. I mean, we might have better strategies that we could pull out with bears and bulls powers with maybe like the envelopes or something like that, but in this particular instance with the accelerator oscillator, it didn't really work out well for us. So I tried the Bollinger Bands and I almost gave up on this one until I found something that was quite unique. Okay, and let's go ahead and just show you that. But first of all, I want to show you something else that I kind of found interesting quite a long time ago, and you may recall me mentioning saying how one of the common questions that I've received from my students is that where do I place my take profit setting, and you can actually use the Bollinger Band to predict that. Alright, so like for instance, if you're familiar with the Bollinger Bands, okay, you'll understand that when the Bollinger Bands, or when the market becomes weak, you'll see that the bands, the upper band and the lower band, start to contract, start to come close together. Okay, and then it creates this kind of bottleneck look, and then eventually, the market starts to pick up pace. So the only thing that the Bollinger Bands can do is to compensate for that expansion, and then it just the upper and lower bands start to move further apart. Alright, and then when it does that, wherever the first candle breaks above or below would dictate the direction of the trend. How long that trend will continue for is not known, but the general start of the direction is established by where the candle is penetrated from. So you can see here that this is where the Bollinger Band starts to tighten up, and then right here it starts to widen off. Alright, you can get my screen draw pen out, and you can see where from there to there it starts to widen out, and this is the first candle, and then after that the market just goes up. Alright, fair enough, there was a little bit of a retracement, but this is referred to as a baseline rally. Alright, there was a lot of demand down here. Okay, alright, so where do you go ahead and place those predicted prices? So here is a section right here. We've just seen this break. Alright, and you're preparing to go long. Alright, so let's say you went long right here, and then you get really nervous because the market came back down. Alright, so we're looking at around about 132.30, and the market came down a fair old bit. I mean, this happens. This is not probably one of the robust strategies to use, but it's a strategy that does work, and that when patience is adopted. Alright, so here is, okay, so we're looking at around about 120 pips stop loss there. Well, it comes down in minus 130. Now, you might say, okay, well, this is way beyond my comfort zone. So what I would say is that once you're in this trade, I would not close out of it until it breaks the lows. Now you see where these little Bollinger Bands down the bottom here kind of go all over the place. Well, this will be used as a stop loss area. Okay, and this one here, see how it comes down. I've just taken the level off of that. this will be your TP. Alright, and you can see the TP gets hit right there. Alright, let's just show you a few other areas. This is where the market gets broken after the market consolidates, and then it breaks out like this, and you can see the candles broken above the Bollinger Band to dictate where it's going to go next. So you're going to go, okay, if I go long here and I put my stop loss here, where am I going to put my TP? Well, my TP is going to go here. You've got a choice, here, here, or here. Alright, you most likely will say here, because from here to there is too low of a pippage, and then, you know, up it goes, and that target got here. Alright, let's see if we can show you another one, just so you can get the general idea. Alright, let's do a short trade. Let's see if we can find a short trade where the market basically, there we go. Alright, so the market's gone sideways and then it's broke. You might say, oh hey Loz, here's one here. Well no, because the close didn't close above the upper band, where you see where the bands start to go sideways for a bit and then it starts to break out. Alright, you will see that this particular candle right here, it did indeed close below that black line. So, and then the rest of the trend was established, and that was your alert. Okay, so where would we go and place our take profit? Okay, well here is the first level. And where would you put your stop loss? Okay, well your stop loss would be around about here. That's your stop loss, and that one will be your TP. Alright, so this move on, and so now you know where to put your stop losses and take profits. Let's go ahead and show you how to open this particular trade open. Alright, so what we're looking for, that it's the same thing with what we've just said, and we're looking for the first candle breakout. Now, you might be saying to yourself, well Loz, okay, well why do I need to use the accumulator, the accumulator oscillator, accelerator oscillator? I forgot what it was. I don't know why they call it AC. It's kind of weird. Yeah, so you might say, okay, well why are we using this particular indicator down the bottom here when we can just use the Bollinger Bands? Well, you'll get some false signals from time to time. Alright, and I like to find areas in the market where I can get 100% perfection at it. I know there's really inverted commas, no such thing as perfection 100% all the way through, but I mean I strive to my best of my ability to get 100% marks. Alright, and the one way to do that is to look at the first instance of where the candle breaks and closes below the Bollinger Band, or the lower band of the Bollinger Band. What I'm looking for is to have the histogram area. I want this vertical line right here. Okay, I want the bars to come under. I'm not interested in all of the up sections. I'm not interested in any of that. Okay, because I'm looking at a downwards trend. Okay, we're looking at this downtrend. Alright, so what I want is I want a confirmation, and I want it to be on the first bar, not the second, not the third, not the fourth, not the fifth, but I want it to be on the first bar. Alright, so I can prepare to go short on the next bar. Alright, so I want it to be one of the very first ones like that there. I want it to be one of the very first ones that come underneath the vertical scale. Alright, so let's go ahead and find some. Okay, well that's not one, because the green area right here is below the vertical scale, so that's no good. Here we go, here's one. Alright, right here you will see that little bar there, the green bar there, lines up with that bar right there. Okay, and we can see that indeed it did actually break above the upper band of the Bollinger Band. Alright, so if you've just turned around and said, well hey Loz, okay, well fair enough, alright, I understand now, but we can't really go long on this one, Loz, because we're on a resistance level. Excellent. If you've just said that to yourself, or shouted it out on your TV or on your monitor, then well done. You're really moving along nicely here. Alright, so there's our first rule. Okay, wait for the break above, and we also need to see the indicator that we have down here at the bottom to be above the 00 level, and it needs to be the first bar, so we can go long on the next candle. But we need to ensure that the resistance level or the take profit level or whatever is not too far, so our entry point is not too close to a resistance level. In this particular instance it is, and that is a kind of a risky trade for 43 pips, especially over a 4-hour time frame, and we're not interested in making peanuts. Alright, so let's just take another look. There's one right here, but this is the fourth bar. Well, actually fifth bar is 1, 2, 3, 4, 5. So that happens on the fifth bar, and then boom, it goes back the other way. So we didn't want that, and plus our signal didn't tell us to go short on that one. So can you see now that sometimes you do get false signals? I mean, the market was kind of expanding out, it went sideways, and it broke below. And you can see, like from other instances when we've talked about when the Bollinger Band breaks for the first time below, or above, wherever it breaks from, it normally dictates the trend. But sometimes you do get those false signals, and this is why it's always good to have an accompanying signal, as I've mentioned before, and I will keep on mentioning. Okay, so we look for that bona fide signal that you can basically put your mortgage on. Well, that's just a figure of speech. I don't expect anyone to put their mortgage on the line. Alright, but here's another one right here. Okay, this is a perfect example. Okay, so here it actually closes below. We'll go ahead and put our TP on the next lower peak here of that Bollinger Band, and we get in on the next bar, and it came down 93 pips, and our stop loss will be up here. Alright, this might be a little bit kind of out of whack for some people, because they will say, well, hey Loz, that's all fair and well with this signal and whatnot, but I'm not prepared to risk 188 pips to gain 90. That's only 0.5 to 1. With that all being fair and well, that's okay as well, but I mean, I like to look at it from if the signal matches, alright, if the signal is within its rules, then I don't mind that, because it's like when you're betting on the dogs or the horses or the football, when you get like a free, say a 64 favourite, and you're in a big field of other big top guns, but some of them are like paying 15 to 1, 8 to 1, 4 to 1, 2 to 1, 3 to 1 or whatever. The majority of the time you'll get the favourite that will come in. Right, so I'll use that kind of analogy towards it, especially when the rules of the strategy play true. Okay, so the reward to risk ratio doesn't really come into it, right, in this particular instance at least. Okay, alright, so let's just see if we can find another one here. Here's a buy signal, I believe. Right, okay, here's a buy signal, it closes above, so we use a bit of common sense. Alright, here it is here, this is where our TP is going to be, so it's just not worth it, right, because it's too close. I mean, it's like 18-20 pips or something, so we won't do that one. Alright, yeah, so there you go. Alright, so give that a try. I mean, this one, you probably wouldn't find many signals within the 4-hour time frame anyway, so you might want to come down a lower time frame and see if this strategy does work for lower time frame. So I'll let you experiment with that rather than me experimenting with it. We're at 14 minutes on this video. Alright, so I can push on and do the other ones while you're studying this particular strategy, and you can use it in conjunction with other strategies as well, so you're not just confined just to this particular strategy. Alright, so until then, I'll see you very soon in the next video. Bye for now.